But let's put the focus now on the auto space. February turned out to be profitable for most of the auto companies. Escorts once again was no exception. To put that stock in focus now, that they posted healthy set of numbers in the month of February. Total sales surged 52% this time around. To really understand the factors behind the growth, we're now joined by Bharat Madan, Group CFO at Escorts. Mr. Madan, thanks very much for joining in. Always good to have you on the show. You know, the numbers for February have been strong across the board, especially so for your company. Of course, you're working with a lower base this time around, but just give us a sense, what has worked for you this time, both in the domestic market as well as the export segment?
I think the major growth this time has come in the domestic market. So domestic business has grown almost 53% plus, and the exports growth was slightly lower at about 70%. Though on a full year basis, the exports growth is significant at 70% plus so far. So we expect, I think the trend is good. The retail momentum on the ground, I think, is pretty good, especially the markets in the south are also now growing. It's driven by good grape outage experience spread, good prices for crops like sugarcane, cotton, as well as onion this time. So we're just seeing very strong growth happening in these markets. And also coupled with the pretty good season now coming, Rabi harvesting is coming in the March-April season. So in the northern and central India should see very good demand.
All right. So that's really what you see driving growth going ahead. So then if we talk about the sales outlook for entire fiscal 18 as a whole, what is the outlook because, you know, we're approaching the year end, so you get a better sense now of how things are looking. Are you expecting this overall to be a strong year?
Yes, I think so far we have grown about 21% in volume this year, and we expect the March will not be an exception. We continue to see good growth traction in March also. So we expect, I think, growth will be somewhere around 20 to 23%, I think, for the company. And the industry probably will also grow somewhere at 20% plus.
All right, 20 to 23% as far as an FY18 goes. And if we look ahead now to FY19, any targets that you have overall for the company, what do you really expect to see as the key growth drivers for your targets for FY19?
In FY19, we expect probably the first half will be slightly extra, so we may not see very strong growth happening there. Though on a full year basis, we are still giving the guidance of 8 to 9% industry growth for full year FY19. But probably you'll see better growth happening in the second half compared to first half. And again, a lot will depend on, I think, how the monsoon also pans out. So in the July to September period, so that'll be another key for the driver of growth for second half.
All right. And, you know, you spoke about the outlook in the monsoons and you're expecting, of course, we've had quite a bit of pressure in the rural sector for a while now. But with the kind of rural recovery that we're factoring in, what is the outlook exactly for your agri-machinery business?
Well, we are hoping to grow in a double-digit number. I think somewhere around 14% sort of growth we're expecting for next year for tractors.
All right. And if we look past the agri-business then, how are things looking like in the construction equipment business front?
The construction has done pretty well. We have grown 30% plus in volume this year, is better than tractors. So we expect probably the momentum will continue to next year too. So we again expect 20% plus growth happening in both construction as well as in the railway segment. So in railway, we already have got a very strong order book, which takes care of, I think, the next year's growth aspiration for the company. So both the verticals are likely to do better than probably the business.
All right. And of course, the other side of things is, you know, your railway equipment business. What is the order book looking like at this point? Where does it stand?
Well, as of end of December, we had 330 crores of order book, which continues to be in that range even today. So this is enough, I think, to take care of the next 12 months demand requirement.
All right. And any, you know, anything you can share with us in terms of the execution pipeline in terms of your railway business?
Execution will be in the next 9 to 12 months for this entire order book. So that's why we expect, I think, the growth for the next year is almost certain on the railway business.
All right. And, you know, Mr. Madan, just want to get a sense from you. Are rising RM prices a concern for the company on the margins front, or are you being able to pass that on to your customers?
So far in FY18, we have been able to on the entire commodity price increases to the market. Now, obviously, the pressure continues on both the steel prices as well as on the rubber prices. So let's see. I think we'll have to really follow the lead, how the competition reacts, and obviously we'll go with the industry.
Right. You know, just finally then, so if we talk about your margins, any outlook that you can share with us? So what are you factoring in for the end of the fiscal and FY19 as well?
For this year, we are looking at almost double-digit margin at a company level, the EBIT margin. And next year, guidance we had given is almost 100 basis points upward movement in the margin. And it will be essentially drained by the tractor business and also probably the turnaround which we've seen happening in the construction business. I think it'll be a combination of both, which will see it panning out in the margin structure next year.
All right, we leave it at that. Mr. Madan, thanks very much for joining in. That's Bharat, the CFO at Escorts, giving us a sense of a strong February month this time as far as auto sales goes, and of course expecting good volumes to continue as we go into FY19 as well. But with that, it's a wrap here on Trending Today. Thanks so much for watching.